Well, greetings and salutations, Series 7 test takers. This is the Series 7 Guru. I'm coming to you from my studio here in fabulous Las Vegas with episode 5 of our Series 7 podcast series on the Series 7 exam. We're presently working our way through Function 3, providing basic product information to customers, 91 questions. We finished mutual funds in the previous episode. That's 20 plus questions. We're going to be covering options in this episode, 20 plus questions. And the next episode in the series after this will be debt securities, more than 20 questions. So that's the meat of this section. Kind of difficult to do options in a podcast format, but I'm going to do my damnedest to do this in an audio form that you can listen to it in the car or on your way to the gym, whatever it is you want to do with it. But I will link to must-watch videos, lectures on options. There's 3, and I'll put them in the video description, links there, as well as a pinned comment. Those lectures are, I'll probably do the class replay of these: basic options, followed by stock plus options, and then advanced option strategies. Those are the 3 videos. That's about 4 hours all in. Obviously, we're not going to do a podcast episode that's 4 hours. We're trying to keep these somewhere in the neighborhood of 30 minutes. So I'll provide those links in the video description, and I'll provide the link to those 3 option videos in a pinned comment. All right, well, options are contracts. Contracts always have 2 parties: somebody who has paid the consideration, somebody who's received the consideration, typically money. So contracts exist outside the securities industry. Now, I think a lot of candidates, test takers, get hung up. They think there's a zillion things going on. There's not. There's only 2 types of option contracts: calls and puts. That's it. There's 2 types of option contracts: calls and puts. You can either buy or sell them. So that means we have 4 basic option positions, right? So that important to know the terminology, nomenclature, vocabulary. And so if you say, Dean, I'm interested in options, and I say, what type of option contracts are you interested in? And you respond by saying, how many types are there? We're not off to a good discussion as it relates to determining suitability, right? It's important, like somebody knows the vocabulary. It tells us whether or not they should be playing. I joke, if I go gambling and I'm not quite sure of the rules of the casino or the table, somebody's got to share that with me, right? So you say, Dean, I'm interested in calls. I say, okay, what class are you interested in? What class are you interested in? They go, what's that? Class is the type plus the stock. Apple calls is a class. Apple puts are a class. You say, well, Dean, I'm interested in Apple puts. I say, okay, well, there's lots of them. That's an incomplete description of the option contract. The problem here is we can't fill out an order ticket. We can't do business unless test point we have a complete description of the security. You say, Dean, I'm interested in Apple 190 calls. Again, incomplete description. There's the Marches, there's the Junes, there's the Septembers. Which one? So the most complete description of an option is the series. That would be the type plus the stock plus the strike plus the expiration, right? So now I can fill out an order ticket or get you a quote, right? You say, Dean, I'm interested in the Apple March 190 calls. The Apple March 190 calls. That is a complete description of that option contract. With that, I can find out what the premium is currently for that. I can fill out the order ticket. And so that is the complete description of the option contract. Now, you want to get as many aim and shoot point and click questions on options as possible. And so we definitely need to note expiration in an option is the 3rd Friday at 11:59 p.m. Eastern time. Now, be careful on the test if I'm asking you about an Apple call contract or I'm asking you about an investor that has an Apple call contract. Those are different questions. So 3 things that can happen to an option contract. I'm not asking what can happen to a player. I'm asking what can happen to an Apple March 190 call contract. I think a good way to remember this is T. That option contract can be traded. That option contract can be exercised. That option contract can expire worthless. So that's a good way to remember what can happen to derivatives, options, rights, warrants. They can be traded, they can be exercised, or they can expire. Now, at expiration, if the contract has any intrinsic value, the contract will be exercised. Now, be careful. Is that good news or bad news? That's a different question. That depends. If at expiration the contract has no intrinsic value, the contract will expire worthless. Is that good news or bad news? Again, it depends, whether you're long or short. Now, we don't want the derivatives, the option contracts, driving the underlying, the stock. We don't want the Apple option contracts driving Apple stock. We don't want the tail wagging the dog. And so we have position limits that apply to the same side of the market. How many contracts are you allowed to have on the same side of the market? So that leads us to a test question about what is the same side of the market. So there's the buy side or bullish side. It applies to, remember this from earlier, the class. What it means like that is Apple calls, Apple puts. So the same side of the market would be long calls and short puts. That's the bullish or buy side, right? Because in the long call, I have a choice to buy the underlying. And in a short put, I have an obligation to buy the underlying. So that test question is what we call or refer to as the buy side or bullish side of the options market. Now, if you get this, they'll say, assuming position limits are. So don't memorize position limits. If it's Apple, Apple's, I don't even doubt if there's position limits on Apple because the float is so large, it would be almost impossible to, use the options to drive the stock. But let's assume it's XYZ. Yeah, I say assuming position limits are 250,000 contracts on the same side of the market. That would mean, if I have 130,000 XYZ calls and 130,000 XYZ calls long and 130,000 XYZ puts short, I'd be in violation of the position limits. Now, one thing to keep in mind on all these things, that question, the same answer would apply if it said a husband and wife. Husband owns 130,000 XYZ call contracts. Wife is short 130,000 XYZ put contracts. You would always consider the husband and wife to be acting in concert. So that would be 260,000, assuming position limits are. That would be 250. That would be indeed a violation. Now, the bearish or sell side would be long puts and short calls. In a long put, I have a choice to sell the underlying, the stock. In a short put or short call, I'm obligated to sell the underlying. So that would be the sell side or bearish side as it applies to position limits. Both of those are bearish, right? Long put is bearish, choice to sell the stock. Short call is bearish, obligation to sell the stock. All right, so exercise and assignment. The Options Clearing Corporation gives assignment notices, test question randomly. Right. So, remember, American style means you can exercise anytime. European style means you can only exercise at expiration. But in terms of those assignment notices, the OCC does it randomly. So they call Merrill. Merrill says, why yes? And, OCC says no rhyme or reason. It's done randomly. Now, within Merrill's client base, they probably have more than one client who is short that particular, here we go, series, right? That particular series, Apple March 190 calls. And here we're trying to say or decide which one of those Merrill clients is going to have to deliver the Apple at 190. They're not going to be happy because obviously, based on this scenario, Apple's somewhere north of 190, right? So Merrill can do it random, FIFO, or another fair method. Draw straws. Right. They can't be discriminatory. What that means is Merrill can't say, oh, man, there's my good customer. I don't want to do it to him. No, I can't say, oh, there's that jerk, man. Got him. So now, whatever method Merrill is using in this scenario, they have to inform the Options Clearing Corporation. They have to inform their Merrill clients. And if they go to change it, they have to inform the OCC and their clients. They just can't be making it up on the fly about how they're going to assign these exercise notices. Now, as we mentioned, you definitely need to know the difference between American style, which is typical for equity options. And that's one of the risks you have if you're short an American style equity option, is that any time somebody can make you deliver the stock. I was going to have $20,000, didn't have $20,000 at the time, and I was going to buy 1,000 shares of the stock at 20. And I was afraid of by the time I came up with the 20 grand, the stock might move again away from me. And so I looked at the 20 calls and they were two. And I said, okay, well, I'll buy 10 of the 20 calls at two. I do have $2,000. And then I can lock in that price at 20. And when I got the $20,000, I exercised in September, even though that was an October call contract. Now, I know the person who received the exercise notice is going to be surprised because, very rarely does that happen. But that's one of the risks that you have when you are short an American style option. European style is typically for non-equity options, and those can only be exercised at the end. So you don't have that risk if you're short. Very testable to how we establish or eliminate an option position. So we said that one of the things that can happen to option contracts is they can be traded. Very testable to how I'm going to establish what type of order I'm going to use to establish a long position. And that's going to be an opening purchase. Opening purchases are used to establish or add to long positions. If I want to establish a short position, that would be an opening sale. Opening sales would be used to establish or add to a short position. Test question: all short positions must be conducted in a margin account. So if the ticket says opening sale, there must be a margin account. The only exception to that would be a covered call. I can do an opening sale on a call contract if I own the underlying without having a margin account. All right, so remember, now I have this option position. I'm long or short. Then again, if I want to trade it to someone else, I need to do a closing transaction. And again, a closing transaction, if I want to offset my long position, eliminate, reduce, or offset, I do a closing sale. Closing sales, test question, are used to eliminate or reduce a long position. And if I have a short position, I say, I want to extinguish that obligation. I would buy back the contract. I would do a closing purchase. Closing purchases are used to eliminate, reduce, or offset a short position. So I would be, as a test taker, I have this in every lecture I ever do for any of the exams, be prepared for an answer set that says A, opening purchase, B, opening sale, C, closing sale, D, closing purchase. Depending on what the question is, will depend on your appropriate response. More often than not, I'd be prepared to recognize that the way you eliminate, reduce, or offset a short position is with a closing purchase. Now, option contracts have a different settlement date than corporates and securities. So you should definitely know that option contracts settle T+1. Now, and the resulting exercise is T+2, just like it would be, right? So if I buy an Apple call contract, that contract settles T+1. But if I am long that Apple call contract and I exercise, that's going to be T+2 on the exercise to buy the stock. The same thing with the guy who has to deliver the stock, right? So T+1 on the contract, T+2 in the resulting exercise or stock trade. I'd be prepared for that. I would know that in index options, if I exercise, I'm long an index option, I don't get the underlying index. Index options, test questions, settle in cash. So, the cash is what the seller, the person who's short, owes me. They owe me the intrinsic value. And they're a little different. The index option contract and the resulting exercise are both T+1 on settlement. So T+1 and T+1. So I would expect you to see an answer set that says A, T+1, comma, T+2. And then choice B would be T+1, comma, T+1. And I say, which of the following is true of a settlement of option contracts and resulting exercise? That's choice A, T+1, comma, T+2. If I ask you which of the following is true of index options, settlement and resulting exercise, you would say T+1, T+1. Again, so Option Clearing Corporation, lots of potential test questions about the Options Clearing Corporation. The Option Clearing Corporation is the issuer and guarantor of all option contracts. So what that means is you don't have counterparty risk, right? So you have the Apple March 190 call. You say, Dean, when I exercise, how do I know that somebody's going to deliver 100 shares of Apple to me at 190? I say, good question. I say, how do they know that you're going to come up with the $19,000? What you're asking me about is counterparty risk, the risk that the other side of the option contract won't make good. I said, well, you have no counterparty risk because the OCC is in the middle and they are the issuer and guarantor of all options. So we said a couple of things. We said the OCC assigns exercise notices randomly. We've now said the OCC is the issuer and guarantor of all options. The OCC test question publishes the OCC disclosure document. By the way, whenever there's three of a thing on the test, just get prepared for the accept. All the following are true. The options clearing corporation, accept. And who knows what the untruthful thing is, right? So now that booklet is an abbreviated version of what's called the OCC prospectus. And that OCC prospectus is available upon request. But, this thing in the abbreviated version, the disclosure document, characteristics and risks, not rewards, it's 100 plus pages. There's no way you can read this while I wait for you to do so. So I say, listen, here is your OCC disclosure document, characteristics and risks of options. I'm going to go back to the office and see if my registered option principal will approve your account. So I give you the disclosure document. I get your account approved. I call you back. I say, hey, good news. I was able to get your account approved. Now, I want to remind you, test question, you have 15 days to get back to me from account approval, the option agreement, which includes a statement that you've read that booklet and you understood it. Right? That way, if you go backwards on me in the future, I say, well, no, here's your signature acknowledging that you read page 33 about naked calls are extremely risky. I'm joking, but not really, right? So now if the 15th day comes and goes and we don't have that back from you, you're only going to be allowed to do closing or offsetting transactions, right? Remember what that means? That means if you're long, you've done an opening purchase, we'll allow you to do a closing sale on that particular series. If you're short, we'll let you do a closing purchase on that particular series, that particular contract. There are some funky options, for lack of a better word, things that work are a little different. So we have long-term anticipation securities, LEAPs, and technically LEAPs go out to 39 months in expiration. In practice, they go out 30 months, 2.5 years. And that means it's the only option position that you could be at risk for more than 12 months. Now, remember, if you are at risk in a investment for more than 12 months, you qualify for a long-term capital gain tax rate, which is typically lower. And so that's one way I could test you on LEAP. It's the only option position that could qualify for a long-term capital gain because it's the only option position that goes beyond 12 months. Oh, by the way, it wouldn't be true if you're short. All shorts are going to be short term. So that's one way I could test you on the LEAP. Another way I could test you on a LEAP is say which one of these contracts is most likely a LEAP. And you go, oh my God, look at the time value on that contract. Right? I mean, you got these premiums on the Apple 190 calls missing the months. And they just show you the premiums and stipulate these are different series. And which one of these, they show you the premiums is most likely a LEAP. And you go, 8 points on the premium, 12 points on the premium, 14 points on the premium. They got something like 26 points. You go, oh my God, that must be the LEAP, right? Another funky option that you might encounter on your exam are yield-based options. And the test question about yield-based options is they have a direct relationship with interest rates. A direct relationship. Oh my God, we spent all this time talking about the inverse relationship of interest rates and bond prices. But yield-based options have a direct relationship. Now, what that means is if I think interest rates are going up, I buy a yield-based call. If I think interest rates are going down, I buy a yield-based put. And again, I can use these yield-based options to either speculate on interest rates or to hedge my bond portfolio. Hedge means protection. It means offset risk. And so, if I was worried about interest rates going up, I would buy a yield-based call, hoping that the money I make in the yield-based call contract, if interest rates go up, will offset what I'm going to lose in my bond portfolio. All right, well, the premium that you pay or receive consists of two components. It consists of the intrinsic value and the time value. Intrinsic value plus time value equals the premium. Looks like I got a little problem there with my banner. That should say intrinsic value plus time value equals premium. So my example, Apple is 191 currently as I'm making this video. And we're looking at the March, April, or March Apple 190 calls. I just told you Apple's at 191. So a 190 call with Apple at 191, call up, has 1 point of intrinsic value. So if the market price is up from the strike price, the call contract is in the money, has intrinsic value. And let's say that the premium is 6. So the Apple March 190 calls, the premium is 6, the intrinsic value is 1, time value is 5. That's the time value. I think it's time value. I don't know if it's helpful, of everything in excess of the intrinsic value. Now, on the test, intrinsic value is much, much more important than time value because, they like to say, and you close out at intrinsic value. And if you don't know the intrinsic value, if it's missing premiums, you won't be able to close it out, right? So if I say, Apple's at 201, and you close out the 190 call at intrinsic value, you'd say, okay, well, 201, that's 11 points. So, that's more important than time value as a test taker. Now, that time value is going to erode. Now, put would be the opposite relationship, put down. If the market price is down from the strike price, has intrinsic value. I like to ask myself, is it likely to be exercised? And that's a framing question I use. And if the answer is yes, then that means the contract has intrinsic value. Is it likely somebody wants to buy Apple at 190 when Apple's at 191? The answer is yes. That means it has intrinsic value. Is it likely somebody wants to put Apple to somebody at 190 when it's at 191? No. That means that contract's out of the money. It has no intrinsic value, right? For a put to have intrinsic value, the market price would have to be down. And so that time value is going to go away. Now, when I had baby brokers who worked for me, baby brokers is not a derogatory term. It's a term of endearment. And I would make my baby brokers write 1,000 times. Options are a wasting asset. Time value erodes. At expiration, an option contract is only going to be worth its intrinsic value. If that contract has intrinsic value, the contract will be exercised. If that contract has no intrinsic value, that contract will expire worthless 999 more times. Options are wasting asset, time value erodes. At expiration, the option contract is only worth its intrinsic value. If it has no intrinsic value, the contract will expire worthless. Right? That's either good news or bad news. If you bought the option contract, you have a short-term loss. If you bought sold the option contract, you have a short-term gain, but that's a different thing. Right? Just be careful again, whether I'm asking you about the option contract or the player, right? The analogy I sometimes use is chess. Am I asking you about the game of chess or the players in the game of chess? Right? If I'm telling my nephews about what can happen to the game of chess, I say, in the game of chess, this game ends with either checkmate or stalemate. Either one of the kings is dead or both kings live. They say, well, is that good news or bad news? I say, well, that depends. Whose king is dead, right? That's the object of the game. So you win, lose, or draw is what can happen to you in the game of chess. That's different than the game itself and those events, like, castling, whatever the case may be. So just be careful as a test taker. And again, same thing with exercise. Is that good news or bad news? Well, that depends on the circumstances, of how much premium you got in, all kinds of other things. All right, so now what we're going to do is do a brief overview of the 9 option strategies you're held accountable for. Again, I will link to the full-blown lectures in this. The full-blown lectures, as I said, are 3 of them. Basic options, stock plus options, that's video 2, and then advanced option strategies, straddles, and spreads. But here in this podcast series, we're going to go over what you're held accountable for, which is profit or loss calculations on these 9 option strategies. That's just me imposing order on it, by the way. There's no test question. There's 9 option strategies. But, I think sometimes test takers struggle. Like, oh my God, there's so many different options. There's not a whole lot of things going on. We're also held accountable to do break evens. All right, so our 9 option strategies found on the Series 7. Let's go over some of our speculative positions. Now, what I mean by speculative is when you come to the options market, you're either speculating or you're hedging. You're speculating on the stock price. You have no stock position. You may end up with a stock position, but you don't start with one. Versus hedging, where you actually do have a long or short stock position, and you're coming to the options market to offset that risk, right? So on the speculative ones, we have long calls, a long call. Now, when you buy an option, you do an opening purchase, whether it's a call or a put, you have to be right about three things. You're buying volatility. You have to be right about direction. On a long call, you have to be right about direction, bullish. You got to be right about how far up. In our example of an Apple March 190 call at 6, you have to have Apple go up at least 6 points to cover your out-of-pocket cost. So you got to be right about direction. You're saying up. You got to be right about how far up, at least 6 points. And you can be right about the timing. This all has to take place between now and the third Friday at 11:59 p.m. Eastern Time in March. Pretty hard. Now, if you just buy Apple stock, you don't have to be right about anything other than direction. So in a long call, you're bullish. Your break even is strike price plus premium. If I really went to teach you options, I'd make you buy one. Once you're out of pocket, you'd figure out pretty quickly how this game works, right? Your maximum gain is unlimited. Once you cover your out-of-pocket costs, 196, above that, you start to make money. And then your max loss is the premium. That sounds like a bad thing, but that's a good thing. Pretty easy to qualify. Use this money you can afford to lose. Now, a short call, you have to be real careful here as a test taker. So if all I do is short a call and I oblige myself to deliver stock and I don't have the stock, that is called a naked or uncovered call. So there's two versions of calls. There's uncovered or naked calls where I'm agreeing to sell stock I don't own naked. I joke, if you're outside the privacy of your own home naked, are good things or bad things likely to happen? Bad things. And we might say, you should cover yourself, right? That means, you shouldn't do that. This is silly. Anybody who wants to do an uncovered naked call means they don't understand either covered calls or credit call spreads. I say, listen, don't be a dumb bear. If you're going to sell an Apple March 190 call at 6, why don't you take part of that and buy a 200 call just in case? Why don't you offset your obligation to sell with a choice to buy? That may be the smarter way to proceed, but it's definitely testable to know that short naked calls have test question unlimited risk. Your max gain when you do an opening sale, go short, is contract or contracts expire, you keep the premium, neener, neener, neener. That's our max gain. Max loss, we says unlimited. Same break even, call up, strike price plus premium. In our example, 190 plus 6. It doesn't matter where you wanted to be in relation to that, but here you're bearish, right? Well, we just said don't be a dumb bear, and here's a smart bear. If you're a smart bear, what you'll do is you buy a put. You'll establish the choice to sell. I was in this chat room and I said, are there any bears in the woods? I'm a bear and it doesn't look like there's any bears around here. And, if you're a bear like me, we got to convince these people why they're wrong about this stock price and that it's not going up, that it's going down. Anyways, this lady pops up and goes, I'm a bear. I go, all right, cool. Two of us. She goes, well, what have you done? I said, well, I haven't decided what I'm going to do, but I'm looking at the put contracts. I think what I'm going to do is buy 10 of the 40 put contracts for 4. I'm going to pay $4,000. I'm at risk for $4,000. I got to be right about 3 things. Again, I'm buying downward volatility. I got to be right about direction down. I got to be right about how far down. In this case, 4 points. My break even is 36. I want to be able to get the stock at 36, stick it to somebody at 40. I make 4, spend 4, I break even. My max gain is if the stock goes to 0, break even 36 all the way to 0, right? I can make somebody give me $40 for worthless stock, 10 contracts, that's 40 grand. I spend 4 to get rolling, so I can make $36,000, break even to 0. Max loss premium, max gain, break even to 0. I'm a bear, right? Break even is 36, right? Again, it sounds like a bad thing, but it's not a bad thing because, again, if I'm wrong, I just lose my premium. Anyway, she told me that what she did was the 40 calls naked. Oh my God. She told me that she hadn't told her husband. I go, oh my God, it's TMI. A short put, right? So if we're going to have put-ers, we're going to have put-es. If we have put-ers, we have put-es. I'm not worried about people who are confused in ways I've seen people get confused. Puts are the ones that throw people usually for a loop. So, what I highly recommend you do is when you get a put is just really kind of take a deep breath and say, okay, a long put, if I'm the buyer, owner, or holder of a put, I have a choice to sell the stock at the strike price. Now, if I'm short the put, I'm the putee. If I'm the short seller or writer, I have an obligation to buy the stock at the strike price, right? So we have putters and we have putees. So if I'm short the put, anytime I do an opening sale, I sell an option, whether I sell a call, opening sale, sell a put, I sell a straddle, I do a credit spread, I sell the spread. The max gain is the contract or contracts expire, worthless, right? And I get to keep the premium, neener, right? That's my best case scenario. So in my Apple example, if we buy an Apple March 190 put, go long 190 minus 6, my break even is 184. You say break even for both parties. So whether I'm the putter or the putee, if I sell the Apple 190 put, oblige myself to buy the Apple at 190, I get 6. My break even is 184. Strike price less premium. Call up, put down is a good memory aid device for both intrinsic value as well as break evens. Right? So max gain is the premium, max loss is somebody makes me buy the stock at the strike price. I have to buy Apple at 190. It's worthless. I get to keep the 6. Whoop-de-doo. I lose 184. My max loss is break even to 0 or just break even, however you want to think about it. And then I'm bullish. I'm hoping that Apple's 190 or higher. Contract expires. Right? So bullish, max gain is premium, max loss is break even or break even to 0, however you wanted to think of that. And break even is strike price less premium. Okay, so on speculative strategies, we also have two speculative option strategies. We have spreads. Spreads always means the difference. What's the spread? Right, I'm making this video as we're getting ready for the Super Bowl. This will live forever, but the Super Bowl that is coming up here in a couple of weeks is going to be the Niners versus the Kansas City Chiefs. I say, what's the spread? What's the spread? I want to make a bet on the difference in those scores. So after the game, what we're going to do is net the two scores to see what the difference is. And some people want the spread to be more than that. Let's say the spread last time I checked was 2 points. So I can say it's going to be within 2 points of the score differential, or it's going to be outside. That's what spread always means, is the difference. So here, spread means we're going long and short the same type of option contracts, the difference in the premiums, right? And we have credit spreads. Credit spreads are when I have more money in than money out. More money in than money out. That's the difference in the premiums. Again, I'm netting those two premiums. Again, I'm a big fan of credit spreads. When I was a practitioner and a supervisor, Series 4, registered option principal, anytime somebody would be talking about doing a naked call, I just yank them and the client, put them on the phone and say, why would you do that? Why don't you take part of the money from selling the Apple 190 calls at 6, take part of that and put in a ceiling at 200. That way you're only playing between 190 and 200. The worst case is you're going to lose 10 points less your credit is your max loss. So in a credit spread, whether it's a credit put spread or credit call spread, what you're doing is taking part of the money you're bringing in. You're selling the call or the put, but you're taking some of the money to put in a floor ceiling. I had a client one time, he drove me nuts. I said, Mark, why in the world would you want to sell 10 of those puts for $240? Oblige yourself to buy 1,000 shares at $240,000. Why not take part of that money and buy yourself a lower strike put? Just in case it blows up and somebody sticks it to you, you can stick it to the next guy. I couldn't get him to do it. I wasn't, I guess, on top of my sales form. Now, debit spreads are when I'm trying to lower my out-of-pocket cost, right? So, maybe I'm looking at the December Apple 190 calls, and they're going to cost me 13 points. And, maybe I want 10 of them, that's 13 grand. I go, oh man, I don't have 13 grand. So it looks like I'm not going to be a player. And I go, well, I think Apple's going up, but I don't make it think it's going much past 210. So I sell the 210s to help lower out my out-of-pocket cost on the 190s, right? By lowering my out-of-pocket cost, that's a good thing because now maybe I can play, right? Let's say it's 13, I can get 7 for the 210s. That means net, again, spread, 13 minus 7. Now it only costs me $6,000 to play, and I only need 6 points of upward volatility to break even. I lower my out-of-pocket cost. I draw my break even closer to me. And so that's what a debit spread is all about. Now, ultimately on the spreads, and again, I will link to my advanced options lecture, but there's 8 things you got to be able to do on a spread. I'm not going to, in the podcast episode, do this in an audio version when, it's more appropriate to have a board, but you got to identify the spread, debit or credit, exercise or expire, widen or narrow, max gain, max loss, break even, bullish or bearish. I call that don't hate the 8. Those are the 8 things you got to do. Now, straddles are a little more straightforward. Straddles, you're straddling the strike price. You're straddling the strike price. Here, you are long 2 different type of contracts. Ooh, nomenclature, vocabulary, long 2 different types. Remember, there's calls and puts. Spreads, you're long and short the same type, right? You're long and short a call, or long and short a put. And we got call spreads and put spreads. So here you're long 2 different types or short 2 different types. We have long straddles and short straddles. So first thing you got to be able to do is identify the straddle. You got to calculate the break evens. This is the only option strategy on Series 7 that has 2 break evens, an upside break even, a downside break even. Again, on speculative strategies, you're either buying volatility, it's your friend, or you're selling volatility. If you buy a call, you're buying upward volatility. You buy a put, you're buying downward volatility. And a straddle, you're buying both. You're saying, okay, I'm not sure which way it's going to go, but can you calculate the break evens? The way we do that is we combine the premiums, total premiums, plus the strike price on the call minus the strike price on the put. That gets our upside downside. Where is it profitable? We have a great mnemonic memory aid for this silo. Short inside. If it's a short straddle, you want it in between those 2 break evens. And if it's a long straddle, you want it outside those 2 break evens, right? Short inside, long outside. When do you use it? When you're expecting volatility, but direction's uncertain. That's when you buy a straddle. For example, I bought a straddle on a company that hired a new CEO. My thought was either the CEO is going to fix their problems and the stock is going to go up, or he's not going to fix their problems, in which the stock goes down. I don't care if he fixes the problems or doesn't fix the problems, just as long as the stock moves. Another time I bought a straddle on a company that was having a legal case. And I thought, okay, well, if they win the legal case, if the court rules in their favor, the stock is going to go up, I think. I could be wrong. And if the court rules against that company, the stock goes down. So I bought a straddle on that company, right? A combination is simply a straddle with different strike prices. You wouldn't do anything different. So a combination is simply a straddle with different strike prices. What I mean by that is you would still combine the premiums added to the call, subtracted to the put, and you're still buying or selling non-directional volatility. All right, hedging. So hedging means protection, right? A hedge keeps good things in and bad things out. And so on the hedging, an option strategy of 9, number 7, and now we switch gears. We either have a long or short stock position. Here we have a protective put on the stock. What we're trying to distinguish is the protective put from the speculative put. This is not a put that I'm buying to speculate on the stock going down. This is a put I'm buying to protect my stock position. I'm putting in a floor. I'm buying insurance on my stock position. And this is the one time and the one time only that my break even in a put is going to be addition. I'm going to add. So if I have the stock, the Apple stock at 191, I own the Apple stock. I buy the Apple stock today at 191. And then I buy a 190 put for 3. My break even is 194. I paid 191 for the stock, 3 points for the protection. I'm out 194. So that is the one time and the one time only that I have a put, and it's not subtraction. Right? By the way, in the call spreads, it's going to be for break even, call, add to the lower, call up. And for break evens and put spreads, it's going to be push, put, subtract from the higher. So again, I'm telling you, this is an exception to calls and puts here. This is an exception to puts because we're adding. The stock position dominates. So again, you got to be real careful here that you don't tell me this is bearish. It is not. You don't want the tail wagging the dog. When I get a stock position, first thing I do as a test taker is say, oh, this guy owns Apple. He's bullish. It doesn't matter what option comes next. If I own the Apple, have a long stock position in Apple, I am bullish. All right, so my break even's 194. I still have unlimited unlimited gain potential. I don't have to sell if I don't want to, right? And now my max gain is break even to the strike. Anytime I want, I can sell the Apple at 190. So, this is very easy to get an ROP to prove this. If I'm the ROP and I say, what does your guy want to do? He says, Dean, he wants to buy puts on stocks that he owns. Like, smart guy. No problem. No problem. So again, this is called a hedge. This gives me the ability to participate in a big price increase, but not participate in a big price decline. We also have covered calls to generate additional income. I say, listen, how would you like to get paid hundreds of dollars in advance to agree to sell stock high that you just bought low? How would you like to get hundreds of dollars in advance to agree to sell Apple stock at 195 that you just bought at 191? We can get 6 points for the 195 calls. That will give you some price decline protection. This is the one time we have a call. And again, it's not a call up here. I paid 191 for the stock. I brought in 6 points for the option. So the break-even here is stock cost 191 less premium, 6. My break-even here is 185. That's what I'm net out of pocket. That's my break-even. I have to sell the stock at the strike price. That's a disadvantage here. My gain is capped. I don't participate past the strike price. And I have 3 sources of profit. I get the 191 to 195, 400 there. I get the $600 from the premium, and Apple pays dividends, and those are mine are along the way as well. Test question: why do you do covered calls? To generate additional income. As we've said over and over and over again, don't be a dumb bear. Before we move on and talk about our last and final option position, I just warn you, don't be looking for tricks. But, if I have 100 shares of Apple and I write 2 contracts, that's called a ratio, right? Who cares? The point is there's no such thing as being partially naked. So, just be covered when you're careful that make sure that you're writing the same number of contracts as you have stock. Because it's not a covered call if you have 100 shares of Apple and you write 2 calls. That's called a ratio, right? I wouldn't worry about it's called a ratio, right? I would just recognize that there's no such thing as being partially naked. So we said, you are getting very tested on things that expose customers to unlimited loss. And that will certainly do the trick, right? Now, if all you do is short the stock, that too would subject you to unlimited risk. And so if you want to be a smart bear, what you would do is buy a call, a protective call. Establish the choice to buy back the borrowed stock at any time between now and some set date at a set price, right? And this is a really neat arrow to have in our quiver, because if you are short the stock and you buy a call, you're changing the short stock position from bearish. Now, be careful. Again, stock dominates. The minute you see short stock, this is a bearish position. Doesn't matter what option comes next. So you got to be careful. You're not, long call, I'm a bull. No. The hedge is always about the opposite market direction. What if the market goes the wrong way on me? And so here, the short stock, I'm afraid the market's going to go up. Right? The other trick is I'm always interested in the offset. So if I bought the stock, I want to be able to sell the stock. Long put. If I'm long the stock, I want to be able to sell the stock. Short call. Those would be the ones that work. The other 2 don't work, right? Here, I could be smart and buy the call. I have a choice to buy back the borrowed stock at the strike price, or I could be stupid. Here, it's mainly recognition. It's not, can you do the break evens and all that stuff? I show it to you in the lectures that I'll pin in the comment and I'll put in the video description. But it's mainly just recognizing that a short stock and long call no longer exposes the customer to unlimited risk. Whereas, test point, a short stock position, a short put, has not been effectively hedged. You still have unlimited loss, because to protect the short stock position, you don't need an obligation to buy back the borrowed stock. You need a choice. All right, so that concludes this podcast episode almost. The last thing I want to touch upon in this episode, options, is tax treatment of options. So remember, we said there's three things that can happen to an option contract. It can be traded. This is pretty straightforward. So this means you do a closing transaction and the tax treatment is going to be short term, right? So if I buy my Apple March 190, call it 6, I sell it for 10, I made 4 points. If it's 4 points means on one contract, 400, on 10 contracts, that's called the multiplier, 4,000, but that's a short-term gain. If I do an opening purchase at 4 and I do a closing sale at 2, on one contract, that's a short-term loss of $200. So all options trading is short-term. I gave you the exception earlier, right? Delete, but Okay, so the next thing can happen is the option contract, remember, can expire. Pretty straightforward. If the option contract expires and you had done an opening purchase, it expires worthless, short-term loss. If you did an opening sale and the option expires, short-term gain. Pretty straightforward. For the most part, exercise. We said three things that can happen to an option contract. It can be traded, it can expire, or it can be exercised. And the last thing that can happen to an option contract is exercise. Now, for the most part, your cost basis follows your break even. So what do I mean by that? I told you Apple's 190. 191. I buy a 190, call it 6. I exercise. My break even is 196. My cost basis in the Apple is 196. So for the most part, if on the test, they ask you, what is the cost basis from the exercise? You do the break even, you'd be fine. So I recommend as a test taker, every time you heard the word cost basis, you do break even as it relates to the exercise of the option contract. You'll be right 99 out of 100 times. Again, our thing is a buffet. The only time, I'm not even sure if I should tell you about the exception, is the only time that that's not the case is when I do a covered call. Right? When I do a covered call, I buy the Apple at 191. I sell the Apple 195, call it 6. My cost basis is 191. And if the Apple gets called away from me at 195 plus the 6, my sales proceeds are 201. Again, I think vendors go completely overkill on the tax treatment of option contracts. I do have in the options playlist, I have, hundreds of videos of options. But in the channel search bar, you can find it there in practice questions. I have an entire episode where I go over, 20 questions on taxation of options. So check it out if you're interested. And then one last thing I want to talk about real quick is hedging using foreign currencies. And we have a nice memory aid device that you probably are familiar with already. If not, here it is for you. U.S. exporters buy puts, U.S. importers buy calls, right? If I'm Boeing, I'm exporting my planes, I'm afraid of the value of the foreign currency going down. You can't buy puts on the U.S. currency because, the U.S. currency is not, the U.S. dollar is not a foreign currency. And if I'm an importer, I'm importing French wine or European wine, I'm afraid about the dollar being weak. That means the euro is strong and I buy calls. All right. So again, this is no substitute for my options playlist, which has hundreds of videos on options. But the most important option videos in that option playlist are the first 3. And I will link to them again in the video description. I will link to them in the pinned comment. And our next episode, I'm hoping you're enjoying these podcast series. The next episode in the series is episode 6 on debt securities. And by way of reminder, the 3 biggest areas in function 3, 91 questions are in your series 7, are mutual funds, options, and bonds. Bonds could be 30, 35 questions. In the old days, we called the series 7 the stockbroker's exam. And, I think it should have been called the bond broker's exam, and it still should. There are way more questions about bonds than there is any other thing. I mean, on munis alone, you get 20. So if you throw in a couple of corporate bond questions and some government bond questions, you're easily looking at 30 performance opportunities there. So remember, inch by inch, your series 7 is a cinch. Yard by yard, your series 7 is hard. And I'll see you in episode 6, debt securities. Bye-bye.